Hello students, we are going to continue with our chapter 8, right? I have covered in this lecture the topic that is factors affecting the capital structure, right? In our previous lecture, we understood the concept of capital structure, what are the characteristics of a capital structure or optimum capital structure, and what are the types. Now, how the need of the capital structure will be decided, or what are the factors that are affecting, right? Mainly, it is divided into two parts, internal and external factors. Starting with the internal factors first, type of a business. That what is the type of business, right? See, mainly you know that when you think about a business, you will be thinking about two ways, that either whatever the things that you are going to sell, that will be what, that will be by purchase. Like suppose I am the one who wants to start a business of a ready-made garment shop, right? So what I will be doing, I will be purchasing from somewhere and I'm selling at my place. That is a purchase business. And other is production, that you are going to employ the four factors of production. You are going to start production, that production process, then you are going to manufacture, then you are going to sell. So ultimately, if it is a production, then yes, the particular type of that capital that is going to require more of a fixed capital, more of a working capital. If it is a purchase business, then yes, small amount of investment that is going to be required, right? There is no need of more capital. Getting my point, right? Then second, size of business, that whether you are involved in the small scale, medium scale, or a large scale of business, right? Depending upon the size of the business. If it is a large scale business, then yes, you are going to require a huge machineries, you are going to require that huge land, you are going to require that huge building and everything, right? If it is a small scale, then yes, you are going to require small amount of investment into the fixed capital, that is fixed assets, and other is working capital. Okay, right? Then third, estimation of business income. See, this is important, right? See, everything that will be done by the finance manager. Okay, so finance manager is going to decide that what will be the income that is going to be generated in the future, right? Or after what period of time the particularly income will be, what income will be more than the cost, right? If the cost is more, expenditure is more, then obviously the need of capital that is going to require more. Okay, right? So estimation that need to be done. See, a finance manager, what he's going to do, he's going to analyze all these things, right? That is factors, and then he's going to estimate, he's going to visualize the thing, yes, that this much of an income that will be generated after this many years or after this many months. Okay, right? Then nature and requirement of asset. Okay, assets, that means fixed assets, right? If large scale business is there, then what we are going to require, we are going to huge heavy machineries, heavy that particular that machines which will be requiring more of a space, right? If small scale business is there, then yes, there will be less investment that is required into the fixed asset. Okay, see, mainly what are the things, yes, a particular thing like textile machinery business is there, then yes, there are huge machines that are going to be required. Getting my point, right? So nature and requirement of assets. Then attitude of directors. Understand this thing. See, if I want to give an example, like that each and every person, they have their own nature, they have their own attitude, right? Some will be defensive, some will be aggressive, right? Few people like to take risk, or other people, they are going to play safe. Okay, so attitude of director is also going to impact the requirement of the capital, right? If I am the one who is starting the business, right, and after 6 months I am thinking to establish more number of units, right? So my attitude is what? My attitude is aggressive. I will be requiring more capital, right? Or other person, like suppose I am the one who is a defensive, let the first unit that need to be settled, and then I will go for another one. Okay, right? Then financial requirements, right? See, depending upon the size of the business, the financial requirement will be more, right? And capital that can be raised through many ways, right? It can be raised through equity side, it can be raised through preference side, it can be raised through debentures, it can be raised through the financial institution that we are going to take a loan from it, from the banks, whatever the things will be. Okay, right? So depending upon the requirement, if the requirement is more, obviously there will be more than one sources that will be there into the capital structure. Okay, getting my point, right? Then duration of capital requirement. See, mainly that those who are starting the that company or starting the particular that manufacturing a production unit, these people are going to be required, what they are going to require the capital for a longer period of time. So they will be issuing what? They will be issuing the equity share, so which can be what? Which can be useful for the future period of time and for a longer period of time. right? It is for a short term, then yes, we can raise the capital through what? We can raise the capital through this taking up a loan from the debentures, we can take up a loan. But if it is for a long term, then we are going to issue the capital, that is equity shares for the raising the capital. Okay, right? Clear? So these are the internal factors, right, which can be controlled by the manager or which can be controlled by the owner or the management, right? Now moving ahead with the external factors, see, mainly the company, the business, the corporate, they are going to be affected mainly or maximally by the external factors. First, condition of boom and depression in the capital market. We have learned the that different phases of a trade cycle in the 11 standard, right? That boom, depression, recession and recovery, right? Boom, that means what? Demand is high, selling is high, earning, that is profit is more. Recession, depression, that means what? Period of what? There will be no demand, no investment, and ultimately what? The market is down. So depending upon that thing, if it is a boom period, then yes, what we can work, we can recover the capital, we can generate a capital more. But if it is a period of recession, then how we are going to raise the capital, right? See, mainly that when boom period will be there, that people or the investors, they will be attracted more towards what? They will attracted more towards the that buying the shares and that debentures and everything, right? But if it is not, if it is a recession, if it is a depression, then they are going to what? They are not going to invest into it. Why? Because market is already down, right? People, they are what? They don't have that particular money to save. Okay, right? Then present rate of interest in the capital market. See, whatever the things will be there, that some sort of interest that need to be paid over the securities, right? Like whatever the things, if you are going to procure the fund, if you are going to get the fund from the capital market, from the share market, then yes, what you need to what? There will be what? There will be some sort of things will be there, you need to do the payment. Okay, right? Like, see, borrowed capital, if you are going to get a borrowed capital, then specifically what? Specifically you are going to pay some default payment, right? And borrowed capital interest rate always be higher than the capital market. Getting my point, right? So sometimes debentures, they are also given a preference, right? If the interest rate is low, right? That means interest rate is low, that means what? For whom? For the particular investor, for the for the particular that company, right? They are what? They are getting the money. If they need to pay more interest rate, then obviously there will be more cost, and that is going to what? Ultimately it is going to what? It is ultimately it is going to increase the cost of capital. Okay, then cost of capital or expenses of issuing the securities. See, in 11th standard we have learned this thing, and again this word is there, that flotation cost. What is flotation cost? That the cost that has been generated, that has been that laid down, right, by issuing the securities, right? If you are going to go into the capital market, whether you are issuing equities or preference, you need to pay some cost, you need to save some point of expenditure over there, right? If you are taking loan from the money market, if you are taking loan from the financial institution or banks, again you are going to pay interest rate. Whatever the things will be are, right, you are going to what? You are going to pay the thing. Higher the cost, obviously there higher amount of expenditure that will be generated by the company. Like suppose you are taking a loan at 12%, right? Obviously you are going to pay 12 rupees over 100, right? Right? And if it is 8%, then obviously what will be the cost of capital? That is going to decline, that is going to decrease. Getting my point, right? So these things will be there, issuing debentures or whatever the things will be are, the cost of capital that will be analyzed, that will be generated by whom? By the particular finance manager, right? Then legal restrictions. See, if you are investing or if you are generating the capital from the share market or stock exchange, obviously you are going to abide by the rules and regulations, right? That has been done, that has been framed by the SEBI, that is Security and Exchange Board of India. Okay, see, I have already explained, like the money market that is run by RBI, that is Reserve Bank of India, right? This capital market, that is stock exchange, share market, that is what? That is generated by, or that is managed or controlled by the SEBI, that is Security and Exchange Board of India, right? They are the regulatory bodies who are going to frame rules and regulations, they are going to make the policies, they are going to make the people, those who are that participants of this SEBI and RBI, they are going to monitor, they are going to manage, they are going to control the working of these such institutions. Okay, right? So this legal restrictions will be there when you are going to issue the securities. You need to that follow the rules that has been created by the SEBI. If you are taking up a loan from the RBI govern institutes like banks and financial institutions, right? So obviously you are going to abide the rules, that legal restrictions that will be there by the laid by the RBI, that is Reserve Bank of India. Okay, then taxation policy. See, these things, right, you know that whatever the profit that will be generated, it is divided into three parts, right? You are going to pay tax, then you are going to particularly having this thing as a dividend you are going to divide, right? Again you are going, if any interest that is there, then you are going to pay the interest, and whatever the things it is there, then you are going to have a return earning, right? So higher the amount of tax, obviously the cost that is going to increase, right? If you are taking government, what they are not giving that particular thing, more interest that will be paid, so obviously what is going to happen, the tax is also increasing, then the cost of capital is going to increase. Okay, right? So you need to think about, yes, what we need to do, borrowed capital that we are going to get, or we are going to have that equity capital. Okay, then institutional investors. Now remember, who are institutional investors? These are the investors which are, you know, the insurance company, banks, some financial institutions, state and a central government. They are the institutional investors, right? Okay, which are going to invest into the thing, like suppose that people, you know, those who are running the banks, so what they are going to do, they are going to collect the money from the common public, that is deposits in the form of savings account, fixed deposit account, recurring deposit, and everything, current account. Okay, and then they are going to, what they are going to give away as a loan, or else they will be investing into what, investing into the huge business, okay, which are reputed business, guaranteed return will be there, right? So these are the institutional investors, right? So attitude of institutional investors, that is also going to impact, right? If trends are there, yeah, like suppose, you know, that currently the shares of this, you know, that Reliance Jio, they are increasing, so they will be investing into such things. Why? Because they have that reputation. Okay, then sorry, foreign institutional investors. See, we have already learned this into the 11th standard. Who are the foreign institutional investors, right? Okay, some, you know, that there will be two things, FDI and FII, that is foreign direct investment and foreign institutional investors. Foreign direct investment, that means what, the people, those who are working into the, you know, that particular foreign companies are there, they are going to come into India, and they are going to establish their physical manufacturing unit in India. But foreign institutional investors, they are going to trade into the share market, that is stock exchange. Okay, right? They are bound to register themselves into the SEBI, that is Security and Exchange Board of India. Okay, yeah, they are legally permitted to do the transaction, to do the trade of purchase and a sale of a shares, debentures, whatever the things will be are, right? They can purchase the share of Indian company, but up to some limitation, not more than that. See, in 11th standard we have already learned that only 49% of foreign direct investment is there, so they can purchase the share up to 49%, not more than that. Okay, right? So these things is also going to impact the requirement of the capital, right, or the factors that are affecting the capital structure. Okay, right? Clear? Fine. Thank you. I'm going to send all the lectures notes in the form of PDF in today by this group, right? Start writing your notes, right? We are having a meeting on Saturday, right? Okay, thank you.